On this week's real estate debrief, rates hold in the low sixes, inventory stays surprisingly firm for late October, and the buyers score the biggest September discount since 2019. For those of you who don't know me, I'm Kev, and I take a week worth of housing data and I break it down into just a couple of minutes of information that you can actually use. I'm talking rates, I'm talking inventory, I'm talking winners and losers, and at the end of this video, I'm going to give you a 60-second playbook so that you can take it out into the world and actually use it. Starting out with the rate radar. The 30-year fixed average is right there in the low sixes, has been all week. Rate around 6.17, 6.27, depending on the tracker that you're looking at. If you're looking at Bankrate, Mortgage News Daily, or Freddie Mac site, you can see that they're all clustered right in that area. The 15-year staying right around the mid-fives, just like it did last week. And the 10-year treasury actually held right around 4%, which keeps the mortgage quotes nice and anchored as long as that lasts. Next is the inventory report. Supply is actually staying surprisingly firm, and we saw another week of growth in active listings, and we're sitting at approximately 16% higher than 1 year ago at this exact same time, which is actually quite unusual for late October because normally we're seeing inventory softening into the holidays, but new listings are actually up about 4% as well year over year. The buyers are being a little bit more picky, and the houses are sitting on market a little bit longer, and you're starting to see a lot more price cuts. So it looks like we're actually seeing some real movement in the supply and demand equilibrium. Finally, we are going to end with the 60-second playbook. Buyers, if you plan to own the house for more than 5 years, consider getting a points breakdown from at least one lender or maybe even two lenders. Target to try to have a break even within 5 to 5.5 years, and this might actually be an advantage over a higher rate straight out of the gate. However, if your horizon is less than 7 years, you might consider looking into an adjustable rate mortgage and comparing it to a fixed rate mortgage. If you do this, though, make sure that you insist on written caps and ask your lender to give you worst case scenario payment estimates. Another thing that you could consider doing is, instead of a small price reduction, ask the seller for credits that you can actually use for loan discount points. Very often, this can actually net you a much better deal in the long run. On the seller side, if you are starting to see some longer days on market in your market or with your listing, you might consider adding to your listing description that you will offer to pay credits so that buyers can use this to purchase loan discount points, because this might actually be more appealing and might actually set you apart from the listings that you're competing against. That's it. That's the weekly debrief. If you like this video, please give it a like and a share. And as always, thanks for watching.